Hello, today I'm going to talk about the latest module within the Jackrabbit modulus framework, Williams percent R or Williams percent range. This algorithm or indicator is one of my favorites, and it can be quite difficult to tune properly. But once tuned, it does an incredibly good job. It is an oscillator, and it is prone to false signals simply because it is an oscillator. Now I'm using strictly the default settings. Nothing special here. Many people regard this as an inverted stochastic. It supports two methods, the crossover and the traditional, and you'll notice that its numbers are in the negative. This is actually normal for the Williams percent R indicator. Let's take and zoom in. You'll notice it's a lot like RSI, but very different in many ways. As you can see, it has some very good high points and low points. It's not necessarily the best approach by itself, and is often coupled with other indicators. Now the overbought down here and oversold up here can be adjusted. The standard is -20 and -80. Some people like to put 40-60 or other combinations. I personally prefer it the way it is for this kind of a situation. Now, as always, Jackrabbit has its own twists to the indicator, and that is you can have a smoothing, and that can give you interesting results and help filter out weaker signals. So it's something to take and examine closely in terms of your risk assessment and functionality. A lot of people prefer 14 as a length, but I have found that 20 works well for a lot of situations. Be sure to take your time and to carefully backtest this strategy. As I said, it is often used in conjunction with another indicator. And I prepared ahead of time exactly one of those conditions. Because as you can see, this produces a lot of signals and not necessarily in your best interest. Now you can just attach this to the dollar cost averaging module and get some pretty good results. For example, let's bring it up and actually do just that. Now I'm going to go with a very simple strategy-based approach. I want to keep this very easy here. Nice and organic. Now I like my take profit at 1.5% because that covers slippage and fees for Binance America. And here we go. Now you can also use an exit position, and I personally prefer using 11. Oops. Because for a lot of these indicators, you really don't need to go above 100 unless you use the sideways breaker. So basically a $111 budget or 10 positions will really do quite well if you choose to use dollar cost averaging. It's a slow process doing this, but it does do well. As you can see, it's going to come out with a very nice little profit over time. So dollar cost averaging is one approach to bringing home this indicator in a much more powerful way. But I'm going to show you something a little different, a little more advanced, and a little more complex. I'm going to show you a situation where dollar cost averaging might actually hurt you compared to other potential configurations. Now, I have dollar cost averaging here as a reference, but I'm not using it. I'm only using ATR as my signal derivative, pulling in the Williams signal line. So these two are all I am using. This is just strictly a reference point to compare the signals. So when this shows a sell signal, look for the sell signal here. When this shows a buy signal, look for the buy signal here, or lack of one. The interesting combination here with this particular combination is that ATR and Williams combined actually perform equal to dollar cost averaging, and in many cases better than dollar cost averaging, as it's able to make more trades on its own with very minimal risk. Now I'm going to go through the settings, but first I want to show you some examples of this combination. This is a very advanced combination. You'll notice here it purchased, dollar cost averaging shows a purchase. Here it shows another purchase. Dollar cost averaging doesn't. So if you're looking for weeding out inappropriate signals, then definitely looking at dollar cost averaging in strategy mode is a good approach. But if you're looking at raw profit, you'll notice that for the most part, every single purchase that this combination makes is right on par with where it should be for the lowest point that the dollar cost averaging shows. And that's the interesting part about this combination, is it has a very good probability of actually getting the lowest values. It also does well in what seems to be an interesting approach of finding the highest values. For example, we go all the way back to the beginning. Dollar cost averaging did less purchases, but profit-wise, ATR and Williams did better overall, even though it made 2 or 3 extra purchases. And you'll notice that the limit of ATR is very small. It really did not go above an extreme number of purchased positions. So let's come back here. You'll notice not a lot of activity. ATR stays in line pretty much with dollar cost averaging. Here's a sell point. Here's a sell point way up here for dollar cost averaging. It matches it, which it should. Here's the buy point. Now here it's only going to pick up a few. Let's follow this back. You'll see that this buy point matches, this buy point matches, but these 3 don't. So this time it's 3 extra buy points, and then you have the beginning of the chain. So 1, 2, 3, roughly a 30-cent profit, crudely speaking, multiplied by this percentage. 1, 2, 3, 4, 5, 6, So double the purchases, but roughly accrued 60% profit. Again, you would multiply that by the percentage. I'm figuring crudely 0.1, but this could easily take this one above $1, whereas this one will be probably 50 to 60 cents, roughly speaking. So this has a much better chance of significantly more profit. And even though it does pick up a few extra positions, you can see that the process stays pretty in line with dollar cost averaging. So as you look and evaluate your risk assessment, do you want minimum positions or do you want maximum potential profit? That really seems to be where this combination differs the most by whether or not dollar cost averaging actually will benefit you. Because as you can see, even the duration is not necessarily going to change between the two different strategies. So bear in mind that that will have an impact on your trading. And that could benefit you quite significantly. But you must be sure to carefully evaluate your risk assessment and your budget. Okay, we're going through a pretty long strain here of no activity whatsoever. And notice that ATR is pretty much on par with no purchases, the same as dollar cost averaging. We see a few scattered sell markers, and even here, a sell marker, a buy marker, right on par with dollar cost averaging. So this literally stays up with this without the extra overhead. So for a small subscription like the Pro, this is an ideal situation. You get one indicator, and you get maximum potential. And it stays pretty much in line with dollar cost averaging. In line to the point that I'm going to remove this from the chart completely. And now we're going to actually talk about the settings. The settings took quite a bit of time to figure out. They were not easy. Let me make that clear right off the bat. These settings were quite difficult to figure out and took a lot of trial and error. I'm going to unlink ATR right now to demonstrate that. So this system does not take a very quick process. As you can see, in order to get the two to line up, I had to put ATR in a different mode altogether because of the complexities between the two indicators. The same holds true for the buy pattern. ATR is quite difficult to link up with Williams unless you really zero in on a very careful process. And I'm going to go through that process right now. First, let's relink these. You wouldn't think that it would be this complicated for this setup, but it is. But the results of that setup, of all those purchases you saw with ATR, all completely eliminated to the best, most profitable that actually compares to dollar cost averaging. So let's start with the Williams settings. There's not really a lot of changes. I used a triple EMA as my smoothing. It gave me some very consistent results and filtered out a lot of the weak signals. I didn't change the length, this is still a default, and I didn't change the boundaries, this is still a default. I did use crossover, which is a more powerful version than a traditional Williams %R indicator. And that makes it also slightly more difficult to tune with other indicators. I did not use any conformational bias. But the results speak for themselves. So as you can see, only the basic components here. This is really it. The smoothing and a crossover. And the crossover is default. So really all I changed in this is just the smoothing, which normally is none. The workload of this comes out of the ATR indicator and finding the best positions that the Williams indicator gives. So let's go look at ATR. Now again, ATR pulls in the Williams signal line. I didn't change too much here, and in fact I really didn't change a lot of ATR settings at all. What I did change is the ATR aggression mode. This has to be on. And see everything nice and tight. So, what looks like complicated, if you know what to change, is simple. If you don't know what to change, or you don't know how to match these two up, this can be a nightmare. So putting ATR in aggression mode, remember that. That is going to be your best and first choice for lining ATR up to another indicator. If you're like 1 off or 3 off or some weird combination. ATR by itself can be difficult without understanding its relationships. So it's always important to look at both indicators. So as you can see, by knowing the indicator, you can get very minimal amount of changes to produce very good results. It's important to take time to study these indicators and these modules and the combinations to learn what fits together easily. See, before I actually decided to go this way, I tried a MACD approach, which does do very well. But MACD does not do as well as this approach. So it's always in your best interest to look at every single option appropriate to what you're doing. So let's zoom out. Let's take a look at the bigger picture. We're at 5 minutes. Let's look at 15 minutes. Notice, unlike other indicators, as you go up in the time frames, the number of purchases won't necessarily increase. And that is also something else that is unique about this indicator combination, is you are not necessarily going to get better performance or higher profits at higher time frames. Each time frame needs to be consistently and carefully tuned, because as you can see, the ATR automatically filters out more the higher the time frame is. It becomes more normalized for the trend. And that is important in your distinction of just how to benefit with this combination. Now this is set to the 10 by 10 cell boundary, which means the price action has to either be down here or up here. It cannot be in the red or the green areas at all. But you can still get profit if you tune it appropriately and know what you're looking for. So as you can see, paying attention to your time frame is important. Higher time frames will not give you better results. Lower time frames will not give you faster results. Here at the 1 minute, and as you can see, it doesn't trade any faster than the 5 minute. You will rack up more positions on the 1 minute, but you may not necessarily get a better cross trade unless your budget can afford it. This is part of the give and take. The 1 minute can provide some benefits, but you have to be careful with your risk assessment. The 5 minute will likely provide you with more profit. As you can see, you start getting into certain trends. The 1 minute candlestick is going to rack up a lot of positions, not necessarily in your best interest. If you wanted to use the 1 minute candlestick, if you don't have the budget, you will need dollar cost averaging. I personally do not recommend this on the 1 minute unless you have the budget and the risk assessment for it. If you do, it will score some serious profits. If you don't, it will wreck your portfolio. I personally prefer the 5 minutes because I find it's the right balance. I can control my risk, I can control my budget, and I can seriously take a look at the combination thereof and find the best positions. So, look at your charts. Go back and forth, scan them. Even look at different coins. Not all coins perform the same. Let's go take a look at everybody's darling, Bitcoin. As you can see, Bitcoin doesn't have much of a change. Not in the context of more trades. The price action is going to be appropriate to its behavior. And there are conditions like this that you will see. This is not just specifically for Bitcoin, but any coin could have this kind of a situation. Again, check all time frames. Look at the volume. Look at the trading. All of which is important and can be a very vital aspect of your trading risk assessment. Here's a situation even at the 5-minute that Bitcoin can rack up some positions and it can average out some nice profits if you are aware of the risks and have planned for them. Do not underestimate your risks. The market can change in a matter of split second. For example, we can go here to the 1 hour, all the way back to Black Thursday. And you'll get a really good approach of what this coin looks like. Now you will have to tune it to trade against this kind of market. But as you can see, just by the ATR ribbons, comparing the price action to the ribbon, everything is on par according to what the calculations would show. That is important. So if you take and really look at your various trading and synchronize and line up and look appropriately, this combination can be a real moneymaker. Take your time. Look at your charts. Understand the indicator. Each indicator has its own unique abilities. By taking the time to study them and seeing how they work on their own, you'll see how relationships like this work well and often can outperform such basic practices as dollar cost averaging. This is a rarity. Most of the time, dollar cost averaging always does better than the strategy by itself. But in this case, the strategy by itself actually can rival dollar cost averaging in a good majority of situations. And remember, it only takes very little changes in most cases to make an award-winning stellar trading style. Not something you're going to want to necessarily use on every coin because it's a long-term strategy compared to the MACD MA, especially version 5. But this strategy by itself is quite nice. Now, if you want a long-term strategy, then adding a dollar cost averaging to it can really take this to the next step if you're willing to wait 2 or 3 months, possibly, for a profit. You will need to balance your position to make sure your position size equals the profit rendered for the time frame you're waiting. And that's one of the biggest drawbacks to using dollar cost averaging on an algorithm combination like this. This actually performs better without dollar cost averaging. So there you are. Simple, sweet, elegant, and it works beautifully in the Pro subscription. Now, is it going to make a profit every time? No. For example, if you look here, here's a buy marker, here's a sell marker. This is going to be a loss. Automatic, that's the way it is. You are going to take losses. Dollar cost averaging will stop that, but it will also draw out the duration you're going to wait. Risk versus reward. That's part of your risk assessment. Don't neglect it. Until next time.